Good afternoon and welcome to TM Wealth Management's Mid-Year Market Outlook. My name is Thomas Senek. I'm the founder of TM Wealth Management, and we're joined today as well with our Chief Investment Officer, Matt Hartson. Sorry, Matt. So we'll give everybody just a few minutes. Got a number of folks logging in today. And so as we begin to get started, just want to give you a little bit of background. What we like to do is keep this pretty short. It's about 30 minutes. We'll go through some slides, some insights about what's happened already this year in terms of the markets, what we foresee for the remainder of the year, what we're watching and looking at, how we're looking at positioning portfolios as well. At the end of this webinar, you also get a survey. We'd ask you please just take a couple of seconds and fill that out for us. You'll also have the option there to request, hey, I'd love to get copies of the slides or some of the other resources that we've talked about. And for those folks that may not know much about us, there'll also be an opportunity to just schedule a quick introductory call, get your specific questions answered, but also see if there might be some mutually beneficial relationship that we can establish as well. So with that, Matt, let's go ahead and pull up the presentation. It has been nothing short of an exciting first half. I think I used that word with a client recently. And they didn't necessarily classify it as exciting, but definitely noteworthy. And so as we kind of go through the agenda today, Matt, if you want to flip to the agenda slide there, what we'll do is, first we'll have Matt kind of go through the first half in review, where we have gotten to so far in the first 6 months. And also we've made some adjustments already in terms of portfolio positioning. Want to share that as well. And then at the end of the presentation, talk a little about what we're watching, what we're seeing, and how we're looking to position portfolios through the remainder of the year as well. And we'll also have some time for some questions at the end. If you do have a question, there should be a chat option in the Zoom window. If you can just type those in, we'll have our Director of Business Development, Christina Layton, pull those up and share those with us. If we don't get to your question, don't worry about it. We will send out a follow-up email answering any questions that we didn't get to. But we really try to keep these pretty tight because we know at the middle of the day, not everybody has an hour or 2 hours for lunch. So we'll keep this pretty tight, but happy to follow up with anybody that has any additional questions. So great, Matt, tell us kind of where we are and how we got here.
Sure. Well, thanks, and welcome everybody. Great to talk to you this afternoon. We're halfway through it, as Thomas said. It was certainly exciting. For many of us, it was also incredibly painful. I was actually looking back before we got started, as we were putting the material together in our last, Thomas, if you remember, sort of our last webinar that we did there at the end of the first quarter. We were kind of right at the beginning, just kind of some of the post-Liberation Day, other things sort of at the peak pain point of the market at that time. And things have sure turned around and changed pretty rapidly since that point. And sort of highlighting that, this was a really interesting chart that I saw that JP Morgan put together. And what you see here in the red dots, that's the max drawdown just this year. So this isn't over some long time period. This is this year. So looking there kind of in the middle at US large cap, you see at the peak of the pain point, we were down almost 19% year to date. However, by the end of June, so the end of the second quarter there, we actually ended up 6. And so, one of the things, I know we got a lot of questions, a lot of concern from clients during that, the first 3-4 months of the year with tariffs and everything else that were going on. One of the things I really drew from this is just how impossible it is to time the market. Who was sitting there post-Liberation Day, market's down 19%, thinking we should be investing more in stocks because it's going to finish the quarter up 6. It's going to bounce effectively 25% from that low point. And I don't know, Thomas, if you had other sort of thoughts about that, but that was really what jumped out to me here is we actually had a spectacular start to the year. International stocks, emerging and developed markets both did really well. We see almost 20% up. So diversification worked, and really staying the course through difficult times really worked for clients. If you were able to do that, endure that pain, that excitement that you're talking about, we've actually had a pretty good first half of the year.
Yeah, I think it just highlights, Matt, that's it. When you're investing in the equity markets, that's what you're getting compensated for, right? When you talk about the equity premium, you're getting a better return in the equity markets than maybe the bond markets, because of this potential pain or this volatility that you have to weather through to be able to capture that equity premium. And so that's when we talk about how we position client portfolios, right? If there's a portion of your portfolio like, hey, I need this money either to live on or a major purchase coming up, that's not where we put the funds. We don't put those in the equity markets. That's where we look for some of the other strategies that we'll talk about later in the presentation here. But I think it's a reminder that, yes, markets don't go straight up, and the volatility is why we get a better return out of the equity markets than the bond market.
Yeah, and you mentioned the bond market there, Thomas. I should highlight that as well. The nice thing we see there, kind of illustrating your point, maximum drawdown we saw on the bond market side was about 2.5%. Now, we never like to lose money, but far more manageable, especially for those short-term cash needs that clients may have.
That's right.
Another big headline, obviously, thing we've been focusing on, the markets have been focusing on over the last several years here is inflation. Generally some pretty good news. We had people very concerned about the impact of tariffs on inflation. So far, that impact has been fairly muted. And you see, from an inflationary perspective, we don't have the June data out quite yet. But what we're seeing here is kind of a moderation down pretty close to that Fed target of about 2%. 2.3, we ticked up a little bit here to 2.4, but staying pretty moderate. We've started to see housing prices come down, shelter costs come down a little bit, and then we've seen some benefits on the fuel side as well, where gasoline prices have dropped a bit to help stabilize this. So much less of an issue from an inflation perspective. What I noticed as I was putting this chart together was, I've done the last 12 months here. The highest number we've seen now is 3. If you remember back just a couple of years ago, we were seeing significantly higher mid-single digits and up type numbers. And so it was sort of comforting to me to see that the highest number, at least over the last 12 months, is that 3% level. Valuations, so stocks, if you remember, as we talked sort of toward the end of last year, stocks had become relatively expensive. And what we saw here earlier in the year with that correction is they started to come down from a valuation perspective. But what's happened, they've bounced back up. And so what this chart is showing you is that U.S. stocks, in particular S&P 500, which are pretty big U.S. companies, they're trading at pretty rich valuations right now. And what does that mean as we think? We'll talk more about our outlook as we move into the second half, but we see more muted returns based on the fact that stocks have really recovered, rebounded pretty sharply, and are trading at pretty expensive, pretty high valuation levels at this point. One of the things I do want to,
as we looked at this graphic, it's also one of the reasons, and we'll talk about this as we get to some of the portfolio adjustments. One of the reasons we started looking internationally, right? Because the multiples, the valuations internationally aren't as rich here as they are domestically here in the U.S. And so, not that we're saying, hey, there needs to be a correction to get us back down to a 17 times multiple in the S&P 500, but it does cause us to start to say, okay, well, something's got to happen to get that PE multiple back within a reasonable range, right? And so as we start to look at earnings and valuation, that's where we start to look at, are there other areas that we might want to diversify into that might not be as rich as the domestic market here?
Yeah, and that's a perfect precursor into sort of the next thing I wanted to talk about, which is the dollar. One of the key reasons that we saw that 20% performance for developed markets during the first half of the year is the fact that the dollar significantly weakened. And so you can see the sharp drop here on the right portion of that curve of that 20% return. Almost half of that came just from the fact that the value of the dollar fell. And our current president, that's something that's important to him. It's something he's said he wants to see is a continued weakness of the dollar. And so from that perspective, we think that's another, Thomas, as you're talking about the international, attractive from a valuation perspective. We also think there may be a little bit of a tailwind coming from the currency side as well.
Yeah, and I think it's a good point, Matt, to also talk a little bit. We've been getting a number of questions about the U.S. dollar as the world reserve currency. And there's been some talk and some meetings with the BRICS nations and everybody else about how do we start to move away potentially from the dollar. And we don't want to discount those conversations and that potential, but that's a decades-long transition that might need to happen. So it is something to be aware of. But I also think given the transparency of our economy relative to the world economies, and democracy that we have here in the United States, and the laws and the rules and regulations we have around our currency, I think it still gives the U.S. a leg up. Doesn't mean that other countries, given what we're doing internationally with geopolitically, that maybe Russia and China, some others might start to look to move away from the dollar, given some of the sanctions we're starting to put on. But I don't see that as a near-term concern because that's going to be a decades-long transition. But it is something to kind of just keep on the radar as we start to see the continued interest in looking at other potential currencies.
Yeah, and I think sort of illustrating your point, when we joined Israel with the attacks on Iran, you saw again that flight to quality, the fear that the treasury rates dropped pretty substantially at that point as people around the world continue to buy the treasury, view that as a safe haven. So I absolutely agree. I think that if that transition ever does occur, we're certainly looking at some significantly long-term future before that happens.
Yep.
Last thing I wanted to just leave with then, as we sort of think about the first half, is everybody's favorite T word now, the tariffs. I love Dr. Yardeni, who's a major economist that I follow pretty closely. He's got his triple T, the Trump tariff tantrum, I guess, is what the three T's stand for there as we're going through. But clearly you stole the headlines through the first half, starting to steal the headlines again here as we move into the second half of the year as well. The tariff rate is up substantially. And even with Trump backing off some of those initial numbers he threw out, we're still at a rate that we haven't seen, really going back to the 30s and 40s in this country. So significantly higher tariffs. They're going to continue to be an issue. The word of the day continues to be, this is what we said at the end of our first quarter. We talked about uncertainty. I think that is going to continue to be the word of the day throughout this year, and probably will end up being the 2025 word of the year is uncertainty. We don't know from one day to the next what the plans are on the tariff side. Clearly has an impact on the market, something we're watching very closely, not only through the first half, but as we move into the second half of the year as well.
Yeah, I also think one of the things we did learn about tariffs, Matt, at the beginning is, at the beginning of the year, people thought, okay, in terms of Trump's philosophy on tariffs, hey, this is just a negotiating tactic. Hey, he's going to throw these crazy numbers out there, then he's going to go to the negotiating table, and we'll end up with something. And that is part of it. But I think what I've learned in the process, listening to the Treasury Secretary, Scott Bessent, to Trump, and to the Commerce Secretary, tariffs is not specifically just a negotiating tactic. They view this as a tool. And so I just heard recently, Scott Bessent, the Treasury Secretary, talking about that they brought in $100 billion in revenue from tariffs. So I think that what that means to me is that there is a tariff policy in the sense that they do want to utilize this as some sort of revenue generating opportunity, rather than just some strict negotiating tactic, some scare tactic. So I think you're right. There is going to be some tariff policy and implementation. The question always now is, okay, what does that mean? All right, are we going to be at the 150% that was initially put on China, or are we going to be something lower? But I think what's clear is it's going to be something higher than what it was at the beginning of the year. And so the challenge that we've had, and when you talk about uncertainty, is we haven't gotten any real data to indicate that the tariffs have had some sort of impact either on pricing or on earnings or on inflation. And we would expected that we would have seen some of that by May or April. Doesn't mean that it's still not coming, but I think that's one of the reasons we start to talk about rates, why the Federal Reserve has come out and said, hey, we're not cutting rates because we still see tariffs as a potential uncertainty, and we don't want to cut too soon and then start to see inflation start to rear its ugly head again. And so I think that what we have learned about tariffs in this first quarter and the second quarter is that they're here to stay. And the question now is at what level? And what's been interesting as we look at the markets and specific traders, I think what's happened now is people have determined that, hey, I can't trade around tariffs because there's too much uncertainty. So I'm going to trade under what I do know. And what we have seen is the markets have determined that the worst case scenario with tariffs is not the base case. And I think that's what we saw in April and May around tariffs is the market said, hey, worst case scenario, that's the base case because we don't know any better right now. And so I think the markets and traders specifically have said, hey, the base case being the worst case scenario, that's really not the potential outcome because we're starting to see backing off some of these tariff rates. And so that's, I think, why we've seen this quick recovery. But it's also one of the cautionary winds that we're watching because it could come back pretty quickly just with a tweet or some new idea around tariffs. So we want to plan around that because clearly for us, what we've seen is tariffs at some level are here to stay.
Yeah, I agree with you completely, and I think your point on that in terms of planning, strategizing really fits with what I wanted to ask you next, and that's how we made some changes to the portfolio positioning over the first half of the year, and what we were thinking there. If you want to sort of jump in on that.
Yeah, I think one of the key things that we've seen over the last number of years is the projections on the growth of the equity markets have consistently come down. Now, the real returns or the realization of that hasn't happened, right? We've had 2 years, 2023 and 2024, of plus 20% year returns in the S&P 500. But the key underlying economic elements of a potentially slower growing, slower return in the equity markets is still a potential and continues to be the projection. And so what we start to look at is say, okay, well, what can we do? One, to minimize volatility in the portfolio, make sure we're at good valuation rates, but also give us the potential for higher returns in the portfolio without taking on significant risk, right? So there's continued uncertainty, lower U.S. equity returns. Interest rates we think are at least higher for longer, and higher meaning we don't see any significant cuts over the next 12 to 18 months. And that could mean that there could be two. I think currently the Fed is projecting two rate cuts. But you think about that, two rate cuts of 25 basis points, that's a 50 basis point cut. That's nice, that helps, but it's not getting us back to the 3% or even 4% or even 5% mortgage rates that I think a lot of people are waiting on. So interest rates still a little uncertain. Tariffs and relates to inflation, still uncertain about what the impact there might be. And so what we looked at is, okay, what we need to start doing is maybe start trimming around the edges. No wholesale significant adjustments, but hey, we've had some really good growth over the last 2 years in our large cap portion of the portfolio. International, from a valuation standpoint, looked attractive. And what we're also starting to see is in the alternative space, things other than stocks and bonds, really getting some great opportunities. So what we did is we pulled back a little bit on our large cap positions. And when we say pull back, about a 2% reduction in large cap, right? Look for an increase in international. So part of that 2% reduction in large cap, we moved into international. And that's been the best performing asset class through this year so far. I think up just a little less than 19% year to date. And then also looking at alternatives, right? Private credit, right? We can get a lower potential risk profile than our equity portfolio, but get into the double digits in terms of yield, right? Private equity. As we start to see the markets improve, we've seen a number of IPOs. I think the big one that we had exposure to in the first half of this year was Circle. They're a stablecoin platform. They went public. They popped about 160% the first day. And then looking at infrastructure, right? As we start to look at the U.S. start to replace and upgrade some of its infrastructure. And then lastly, looking for income in other places other than traditional bonds or dividends, things like music royalties or life insurance settlements, right? These are things that'll move independent of the broader market. So it reduces the overall volatility in the portfolio, but also increases the potential return and the yield. And these are some of the themes that we're carrying through the end of the year as we start to talk about some of the things we're watching through the remainder of 2025.
Yeah, I think that's a perfect sort of segue into the second half outlook and what we're seeing and how we'll continue to sort of extend and make changes as necessary in the client portfolios. The first issue, one we're watching very closely, is what's the employment look like? What we have right now are a couple competing forces. We've got slower immigration. That's, we think, is going to help mitigate some of the impact of a labor market slowdown, because we're having some deportations, those sorts of things that are taking some workers out of the workforce at the same time that the overall workforce is slowing. So what we saw actually last week was a pretty good employment report. People were concerned that it wasn't going to come in as strong as it did, But if you looked under the hood a little bit, what you saw is for the 147,000 jobs that were added, 130 of those were in the government sector. So we weren't seeing the private sector employment that we certainly would like to see, better sign of a more healthy employment market. In addition to that, even though unemployment dropped from 4.2 down to 4.1, that was driven largely by a reduction in the labor force. And so our forecast, as we're thinking about positioning for clients as we go forward on the employment side, is probably higher unemployment, but manageable. So to your point, Thomas, about uncertainty in the markets, but things still doing pretty well. I don't think we see employment dropping off the table. I think everything should continue to move along, just maybe not as strongly as we've seen over the past couple of years.
Yeah, I think that plays into the uncertainty piece, right? And the tariff piece, right? A company in the private sector is not going to start hiring a whole bunch of people if they think that their margins are going to start to get compressed because of tariff rates, or their demand might go down because of potential tariff rates, right? Or people looking for cheaper options, or changing their buying habits. So I think that's part of the uncertainty. We look at the employment outlook. But there's also some potential impacts to employment that the recently passed Big Beautiful Bill might impact positively, potentially, in the unemployment. So again, a lot of moving parts and pieces. I think the core takeaway is, with unemployment at 4.1%, right? That's a pretty healthy number. And until we start to see that tick up, getting closer in, to the 5% range, we don't see that having a dramatic impact on the overall health of the economy.
That's exactly right. And then as you sort of continue that into the tariff discussion that you mentioned there, giving us that uncertainty. I don't think Trump likes this acronym, but they came up with the Trump always chickens out trade during the first half of the year here. You have the deadline that was, what is today? The 9th. I guess the deadline was today. I'm losing track of days. Was no longer the deadline. Moved that out to August 1st. Now he has, of course, said he's not extending it again. So, we've got a 3-week reprieve here to work through some of these trade deals. But the bottom line, Thomas, as you said earlier, is tariffs are going to be higher. He just came out and said he's taking Japan and South Korea up to 35. Expressed some concern this week about BRICS-aligned countries, the potential for additional 10% tariff there. He's threatened the EU with 50% tariffs. We've seen some stuff on copper as well. I put our brilliant forecast. Hopefully the clients appreciate all the brilliance we have here. Impossible to predict, but as you said before, higher levels than what we've seen recently.
That's right. Very detailed analysis.
Yes, that's why we get paid the big bucks, is because we have that brilliant insight. On the large cap side, we talked about this before, as we're moving into the second half of the year. If you look at the consensus analyst forecast out there, they're seeing about 7.5% returns over the next 12 months. So, again, as you said, not seeing significant downturns. The economy continues to move forward, but given the higher valuation levels we talked about, not quite as much potential here on the large cap side, which is what feeds into one of our key theses here as we move into the second half of the year. The U.S. still makes up about 2/3 of the overall global equity markets. And if you look from a valuation perspective, as you alluded to earlier, really attractive valuations on a relative basis. You can see here on the left of the chart on the right that US is trading at pretty significant premium here, fairly expensive. If we look around the rest of the country there, we're seeing much more attractive valuations. Combine that with what we talked about Trump wanting a weakening or weaker dollar, we think that really gives us a good opportunity for the international markets to continue to outperform during the second half as well. Other thing we wanted to just mention is bond math today. A lot of people are still a little bit gun shy about bonds because 2022 they didn't do what they were supposed to do. They didn't provide that buffer when the stock market fell. But what we're starting with now is not those really low rates you were talking about before, but relatively attractive rates. Rate levels we haven't seen unless you go back to the early 2000s since we saw Treasury yields at this level. And what we think is pretty compelling, if you take the analyst forecast of 7.5, which of course is not going to be right, but if you say that's in the ballpark of what we're seeing from large cap equity, we can certainly see an opportunity here where if rates do move down that, let's say 0.5% you were talking about, Thomas, we're seeing 6% returns on treasuries in that type of environment. If you go down from roughly 4.5 down to 4, Obviously, if we step down even further, we would see even stronger returns there. But even if rates stay constant, just picking up that yield at 4.5, pretty attractive on a risk-adjusted basis when you're looking at that relative to, let's say, large cap U.S. equity, that where we're thinking again, kind of low to mid single digits.
Yeah, I think that's been a change, Matt, in terms of how bonds have performed and where they fit within the portfolio. It's been for decades with rates, close to zero, that you got nothing for your, in terms of a real return in your bond portfolio. Now, given some of the strategies we're implementing, right, you're now able to get with very little risk, somewhere around 4, 5, or 6%, and just going up the risk spectrum just a little bit. Now you're starting to get the high single and low double digits without, increasing the risk and now providing a buffer for some of this uncertainty. So basically, the way we look at it, you're getting paid to wait, right? Before, with money in bonds and the, putting money in bonds, you were getting paid to wait for what the uncertainty was in the equity markets. Now we can put some money, especially short-term money that you might need, into something that's still going to pay you to wait and get some of the uncertainty in the equity markets cleared up.
Yeah, absolutely. And I think that kind of flows into our sort of summary here as we look to wrap things up and meet that deadline you were talking about. I could talk about this stuff all afternoon, but from a U.S. equity market perspective, what we're seeing, probably continue to melt up until they don't. The analysts have brought down their estimates pretty substantially for Q2. So I think there's a high degree of likelihood that the companies can exceed those estimates now that have been lowered. So the analysts were initially estimating 7 or 8% growth. They brought that down to 4 or 5. And so I think that's a pretty low hurdle to meet. So we could continue to see some of the melt up on the U.S. equity side, which ties back to what you said, why we made adjustments. We didn't make wholesale changes. We certainly didn't sell all of the U.S. equity. Another optimistic piece that we see here is broadening. We've started to see early signs of value outperforming growth. Small cap had a good month. 1 month certainly does not a trend make, but if we can get some of that uncertainty behind us, we can continue to move forward there. On the
I also
international
think, Matt,
side,
this ties into what we said at the very beginning, right? With the max drawdowns in different asset classes, right? Is we can't, and we don't try to time the markets, but we can start to minimize the impact of the volatility. I think that's what we're looking at is there's uncertainty associated with that. I do also think when you talk about kind of the positives, and we'll talk about this a little bit towards the end here, is one of the positives that also gives us some insight that the markets might go higher is with the passage of the and into law of the big beautiful bill, right? Like it or not, it does remove uncertainty. Right now, corporations and individuals know what their tax rates are going to be. They know where the spending is going to be and when their potential cuts are going to be. And so now you can start to adjust your strategies, given that we have some certainty around that. And so I think given, again, the federal government continues to spend, that's a positive for the markets. It's a negative for the overall economy and our country. But from a markets perspective, in the short term, that also can lead to what you've quoted here, this melt up. So we don't want to go completely defensive because we're not trying to time the markets, but we do want to be cognizant of the fact that there are some headwinds potentially in the market towards the second half here.
Yeah, and I think that ties into our again, a little bit of a increased allocation international, where we're seeing now there is an alternative. If you remember a few years ago, we had the TINA trade. There is no alternative. Well, now we have some, whether it's international or from a positioning perspective, bonds look very attractive relative to stocks, as we talked about. Shifting into some more value. And then, as you mentioned before, Thomas, as well, we really see some opportunities and alternatives. Been a lot of changes in those markets over the last several years to give better access from an investment perspective. And we think getting some of those non-correlated in return streams can be really important to help smooth some of that volatility that we certainly expect we'll see throughout the remainder of the year. One thing I'll bet on for sure is it's not going to be a straight line up from here.
I'm with you on that one. Well, great. Well, thanks, Matt. I mean, there's a lot, like you said, you and I talk about this every week. Matt and I have our investment committee meetings every week, and we talk about, these things, review client portfolios, the specific performance and returns and allocations. So we could spend, hours on end about this stuff. But those are some of the things that we've seen, that we're watching, some of the positioning we've started to take. So let's bring Christina back on here, see if there's any questions. We'll probably just take one or two because we're we're bumping up against our time, but any specific questions, Christina?
Yes, we actually have two questions. The first one, can you guys talk about crypto and Bitcoin? With debt spiraling and totally out of control, should we prepare ourselves for a situation 10 years from now when Bitcoin is a mainstay and an integral part of our world financial system?
Sure. So we get this question a lot. It really depends on your overall risk profile. Because if you look at what Bitcoin has been able to do, it's gotten a lot more institutional following, but there's no underlying intrinsic value, right? You can talk about gold. You could even say the same thing about the dollar, right? Maybe the dollar doesn't have any underlying intrinsic value, but what it does have is this huge economy standing behind it, right? And so the challenge that I see with Bitcoin is if it starts to challenge the any government's control of the financial system, they'll start to regulate away from the cryptocurrencies. Now, you'll hear people when I make that comment say, "Well, you know, it's probably too late for that anyway." And I would say, "Well, we'll see." So, you know, from an allocation standpoint, if your risk profile is such that, hey, I want to look at some of the, again, these alternative positions, we can look at, we've helped other clients look at, you know, adding a portion of crypto to their overall portfolio, kind of a toe in the water approach. But again, I don't see that there is going to be a dramatic shift away from the reserve currency because that's a decades long transition. Not saying that it couldn't happen, but it's a decades long transition. And do we see crypto, which is a disintermediated, anonymous type of currency, replacing something that is backed by, you know, the largest economy, most transparent government system, relatively speaking, in the world? I don't know, Matt, if you've got some additional comments there.
No, I think you summarized it well. I mean, I think to me, any sort of investment at this point in something like Bitcoin or any of the other cryptos is pure speculation. And you're just betting that someone else is going to be willing to pay you more for that later. But as you said, there's no fundamental intrinsic value. Yeah, and so from that perspective, hard to consider that a good long-term investment until you can figure out a way to actually value it.
Yeah. Great, Christina, next question.
Okay, the last question is, does your employment outlook consider the mass federal layoffs? Supreme Court just cleared the way, or is that too small of a number?
That's a great question, especially in our area, right? In the Northern Virginia area, the federal government employs a lot of people. So it is a significant concern about how the federal government is going to change and the impact that it might have not only on our local economy here, but individuals, right? This is, you know, take this down to an individual level, losing your job is a significant economic impact. But as we look at the overall impact to the broader unemployment, right? Even a million people, a reduction in workforce from the federal government of a million people, from a broader economic, unemployment impact, it doesn't significantly move the needle in terms of unemployment. Not to say that that's not a significant event, that it's not going to have changes to the broader economy, both domestically, both locally and nationally, but from an unemployment standpoint, we don't see that number having a significant impact on moving the unemployment number. Matt, I don't know if you've got some additional insights there as well.
Well, the only thing I'll mention just on that is I think, you know, hopefully with the disastrous experience of Doge, the government has learned a little bit of a lesson that yes, everybody wants to get rid of waste. Not one of us want one of our tax dollars wasted, but there are some really important roles that federal government employees play. And I think I like to believe that they've sort of learned from that experience. And if they do, you know, I realize the Supreme Court has given them more authority, but that they do it in a targeted, deliberate approach as well. So you're exactly right in terms of the numbers, but I'd like to think we've learned our lesson and we'll look to do it a little bit more intelligently as we go forward as well.
Yeah, I think that's a good point because I think what we saw initially was, hey, let's break stuff, see what else breaks, and then come back and fix it. And what that resulted in, hey, we got rid of some people, then we had to bring them back. And so to your point, the hope is that now they're taking a more strategic approach and saying, okay, rather than just breaking something, see what else breaks, let's take a strategic approach and say, okay, where could we maybe be more efficient rather than just a wholesale, layoff approach. So yeah, that's a great point. Again, we appreciate everybody joining us today. If you have other questions, we'd be happy to answer those. Feel free to either put them in the chat, shoot us an email. Please, again, take a moment to fill out the survey at the end of the webinar. That's really helpful for us, but also gives us some indication about how to follow up with you if you'd like copies of the slides, or you've got other specific questions or concerns that might relate to your specific situation, right? And that's where we can really add some value. We talked in broad themes today, but really at the end of the day, finance, financial planning, investment management, that's a very personal approach of how to deal with that. So feel free to reach out to us. So again, Matt, thanks for the time. Appreciate everyone joining us today, and have a great week.